The US dollar looked ready for another weak week after softer inflation data reduced expectations for higher interest rates. But then, global tensions suddenly changed the picture. As conflict between the United States and Iran intensified, investors rushed towards safer assets, helping the dollar recover some of its losses. So, is this just a temporary bounce? Or could geopolitical risks become the dollar's biggest support in the weeks ahead? Let's break down what happened, why markets reacted the way they did, and what it could mean for investors. It was a week driven by two powerful forces pulling financial markets in opposite directions. On one side, encouraging inflation data suggested the Federal Reserve may not need to raise interest rates anytime soon. That normally puts pressure on the US dollar. On the other side, escalating tensions in the Middle East pushed investors towards safe haven assets, limiting the dollar's decline despite changing expectations for Fed policy. By Friday's close, the US dollar was little changed for the day, but it still ended the week modestly lower. Let's start with the biggest reason the dollar came under pressure in the first place. Softer inflation changes the market's expectations. Earlier in the week, fresh inflation data showed that price pressures cooled during June. That report encouraged investors to rethink how aggressive the Federal Reserve might be over the coming months. When inflation begins to ease, the Fed has less reason to keep raising interest rates. And when expectations for higher rates decline, the US dollar often loses some of its appeal because investors may find fewer opportunities to earn higher returns from dollar-based assets. As a result, traders reduced their expectations for another immediate rate increase, putting downward pressure on the greenback throughout much of the week. Geopolitical tensions bring buyers back to the dollar. Just as the dollar appeared set for a bigger weekly decline, global events shifted investor sentiment. Renewed fighting between the United States and Iran following the collapse of last month's ceasefire increased uncertainty across global markets. Investors also became concerned about potential disruptions to shipping through the Strait of Hormuz, one of the world's most important energy trade routes. Those concerns helped push oil prices to their highest levels in nearly a month. Whenever uncertainty rises, many investors move money into assets they believe are relatively safer during periods of market stress. The US dollar is often one of those preferred safe haven assets. According to market strategists, the combination of geopolitical tensions and weakness in global stock markets encouraged investors to return to the dollar, allowing it to recover part of its earlier losses. Despite the late-week rebound, the US dollar index finished at 100.76, ending the week down about 0.2%. The euro remained relatively steady, trading around $1.1436 and posting a modest weekly gain. The British pound slipped slightly on Friday, but still recorded its third consecutive week of gains. Stronger UK economic data and expectations of greater political stability continue to support investor confidence. Meanwhile, the Australian dollar also completed its third straight weekly advance, although it weakened during Friday's session as investors reduced exposure to riskier assets amid growing geopolitical uncertainty. Together, these moves highlighted how markets were balancing economic data with rapidly changing global events. The U.S. economy continues to show strength. While investors focused heavily on inflation and geopolitics, new economic data suggested the U.S. economy remains on solid footing. Consumer sentiment climbed to its highest level in 5 months, indicating that many Americans remain optimistic despite ongoing uncertainty. Retail sales also increased slightly during June. Although lower gasoline prices reduced spending at service stations, strong online shopping helped offset that decline and encouraged economists to raise their estimates for second-quarter economic growth. At the same time, labor market data continued to point toward a stable job market. Taken together, these reports suggest the U.S. economy is still showing resilience, even as borrowing costs remain elevated. That strength gives the Federal Reserve more flexibility as it weighs its next policy decision, making upcoming economic reports even more important for investors to watch. What the Federal Reserve is likely to do. Next, despite the economy continuing to perform well, financial markets now expect the Federal Reserve to keep interest rates unchanged at its upcoming policy meeting. The main reason is June's inflation report, which showed price pressures cooling after several months of stubborn inflation. While that was encouraging news, Fed officials have consistently emphasized that one positive report isn't enough to declare victory. Instead, policymakers want to see a sustained trend of lower inflation before making any major changes to monetary policy. Their goal remains the same: bring inflation back toward its long-term target without unnecessarily slowing the economy. For now, that means the Fed is likely to remain patient, carefully evaluating each new economic report before deciding whether additional rate increases are necessary. How market expectations have shifted. How market? Investors have already adjusted their outlook in response to the latest data. According to the CME FedWatch tool, the probability of another Federal Reserve rate hike in July fell to about 14%, down from roughly 25% just 1 week earlier. At the same time, traders continue to expect some additional tightening later this year, with markets pricing in around 30 basis points of total rate increases by December. Not everyone agrees with those expectations, however. Sean Osborne, chief foreign exchange strategist at Scotiabank, believes markets may still be expecting too much additional tightening. In his view, the U.S. dollar may have already reached its recent high a couple of weeks ago, suggesting its strongest upward momentum could be behind it, at least for now. That difference in opinion highlights just how uncertain the outlook remains as investors wait for more economic data. Why the Japanese yen remains under pressure. While the U.S. dollar experienced mixed performance, Japan's currency continued to struggle. The yen traded near 162.44 per U.S. dollar, remaining close to the nearly 40-year low of 162.84 reached earlier this month. Such a weak currency has kept traders on alert because Japanese authorities have previously stepped into the foreign exchange market to support the yen during periods of excessive weakness. Finance Minister Satsuki Katayama repeated that the government stands ready to take decisive action if necessary. Those comments reminded investors that direct intervention remains a possibility. However, some market analysts remain skeptical that verbal warnings alone will be enough to reverse the yen's decline. Similar statements in the past have had only limited and temporary effects unless accompanied by actual intervention in currency markets. For now, traders continue watching both the exchange rate and signals from Japanese officials very closely. What investors should watch going forward? As this week demonstrated, financial markets are being influenced by both economic fundamentals and global events. On one hand, easing inflation has reduced expectations for immediate Federal Reserve rate hikes, creating pressure on the U.S. dollar. On the other hand, rising geopolitical tensions have increased demand for safe haven assets, helping the dollar recover some of those losses. The balance between these two forces will likely determine where the dollar moves next. Investors will be paying close attention to upcoming inflation reports, employment data, and any new guidance from Federal Reserve officials. At the same time, developments in the Middle East will remain an important factor, especially if they continue to affect energy markets or broader investor confidence. Until there is greater clarity on both the economic and geopolitical fronts, currency markets are likely to remain highly sensitive to new information, with even a single report or major headline capable of shifting expectations in a meaningful way. The bigger picture for investors. Looking beyond this week's headlines, the key takeaway is that markets are no longer being driven by a single story. For much of the past year, investors focused almost entirely on inflation and the Federal Reserve. But now, geopolitical developments are playing a much larger role in shaping market sentiment. That's important because these two forces can push the dollar in opposite directions. When inflation cools and expectations for higher interest rates decline, the dollar often weakens. But when global uncertainty increases, investors tend to seek the safety and liquidity of U.S. dollar-denominated assets, which can strengthen the currency even if interest rate expectations are falling. This week's market action was a perfect example of that tug of war. Economic data pointed in one direction, while geopolitical risks pulled investors in another. For businesses involved in international trade, multinational companies, and investors with global portfolios, these currency movements can affect everything from import costs and corporate earnings to overseas investments and commodity prices. What could move markets next? Looking ahead, several major developments could determine the dollar's next move. First, investors will closely watch upcoming U.S. inflation reports to see whether June's cooling price data marks the beginning of a lasting trend or simply a temporary improvement. Second, labor market reports will remain critical. A strong job market could continue supporting the broader economy, while any signs of weakening employment could change expectations for future Federal Reserve policy. Third, every statement from Federal Reserve officials will be analyzed for clues about the path of interest rates over the remainder of the year. And finally, geopolitical developments, particularly in the Middle East, will remain in sharp focus. Any escalation or easing of tensions could quickly influence investor sentiment, oil prices, and demand for safe haven assets like the U.S. dollar. With so many moving pieces, market volatility could remain elevated in the weeks ahead. To sum it all up, the US dollar ended the week relatively steady, but still posted a modest weekly decline as softer inflation data reduced expectations for another immediate Federal Reserve rate hike. At the same time, renewed conflict between the United States and Iran created a wave of risk aversion across global markets. That uncertainty encouraged investors to seek the relative safety of the dollar, helping offset some of the pressure created by changing interest rate expectations. Meanwhile, the broader U.S. economy continued to show resilience through solid consumer sentiment, steady retail spending, and a stable labor market. Even so, the Federal Reserve is expected to remain cautious, waiting for additional evidence that inflation is consistently moving lower before making its next policy decision. For now, investors are navigating a market where economic data and geopolitical events are equally important, and either one could shape the next major move in currencies, stocks, bonds, and commodities. The coming weeks could be especially important for global financial markets. Will easing inflation keep reducing expectations for higher interest rates? Could rising geopolitical tensions continue supporting the US dollar despite that trend? And what will the Federal Reserve signal at its next meeting? Those are the questions investors around the world will be watching closely. If you're interested in staying informed on the latest developments in the U.S. economy, financial markets, investing, and global business news, be sure to follow along for more in-depth market updates and clear, fact-based analysis. Thanks for watching, and we'll see you in the next video.